Hi, Warriors. As a sign of our commitment and dedication, Blake and I and Paulie are working on a national holiday in service of our community here on F.A.C.E. No, we didn't even know. We're just, we love our work. So we even work when markets aren't going to do anything. But you know what we could do? We could prep for the week. And, Friday, we really didn't have a chance to talk about what happened Friday. The only thing I did Friday is I tried Aussie at 61.8. I'm not looking for just a scalp. It's break even now. A lot of confluence here. I don't even know if we'll get here, but if we do, that's where I'd book it. So let's see who's here on this national holiday.
We are.
Everyone. Okay. So
good morning, Coach.
Hey, Blake.
Thank you for your dedication.
Oh, our commitment and dedication and spacing out. So anyway, I'll start with you, Ryan. So, Friday was a key day. I know a lot of eliticians have flipped on the dollar. Everyone has turned negative, many that were looking for more of a bounce in the dollar have turned negative the dollar. So with what happened here Friday, I have to, I know you think 110 is going to be a pretty good barrier, and, so far it is. So are we going to get a right shoulder, or should we be looking for another high up towards 112? Does that look viable to you, 112?
Yeah, it looks viable. As I said on Friday, got to get above the sticky 111 first. But it's, you could say the die's been cast, but this is still, in my opinion, very much a yen move more than a dollar move.
Okay.
I was looking at the numbers last week for the whole of the week versus the dollar. The yen was the only negative currency, or positive currency rather.
Yeah.
All the others gained versus the dollar bar the yen.
Okay.
So, and the yen story is even clearer. There was no currencies that weakened versus the yen.
Okay.
So
are we getting into levels where you might be an interested seller in the end?
No, not really. I'm in the mood where I want to see where this goes.
Okay.
Because I'm not fully on board with why it's happening. Obviously, a big part of it is is the carry trade. We've had central banks hiking, the Bank of Japan still staying on hold, where there might have been some small expectation that they might, drop a few more hints in, and they haven't. So, you've got a green light for the carry mob to get back in or add to their positions.
Okay, so we had a breakdown in Canada, right? I think it was this day. I don't have those rectangle lines drawn, but there it is. I mean, it's pretty obvious. This is a breakdown. This measure is pretty big if you believe in it. That's another pretty big range. 38, 500 gives you about 28 if you just do a measured move there.
Yeah.
You think we're headed there?
It's got the possibility. This, if it holds, if it cements itself under 132, I think we're heading down there. I've got a reasonably big level at 130.80. Strange number, but who am I to argue with price action? 130.80 is a big historical level as well. It's looking very weak. The bounces are very shallow, or very dead catish, and you got to say the trend is your friend. And also, oil seems to be having a little bit of a bid on. You've got a double win for the loonie at the moment.
Okay. Yeah, oil's been not going down, which so I thought we might get one more test here, but I don't think so. Looks like we're putting in higher lows. Maybe make a run at $85. Where would that could put Canada at those targets with a weak dollar on top of it.
it'll also give you more inflation, won't it?
Yeah, the Fed. The big Fed. The big Fed wussed out again.
Supposedly.
Yeah, he did. I mean, everyone else is tightening. So I don't know, why don't I go to Stel? Some give back action here.
Good morning.
Good morning, buddy. So this is, a lot of the bulls are saying this is it, and they expect it to hold and get a rally to new highs. And, with the dollar backdrop, it sounds, that would give the argument a little bit of weight, wouldn't you think?
Yeah, the issue is that the dollar's been weakening and gold has gone sideways. So silver as well. So it's not the most
the correlation's not.
Yeah, it's
you
not
can't
there
count
yet.
on it.
Yeah, I mean the levels for gold are quite simple. 1930 and change, 1935, let's say 1985. Now today we're seeing, the usual overnight selling of metals. Almost every day they do that, no matter what happens in the background. This is not it yet for me. Many people are saying, oh yes, the dollar is weakening, the Fed is done raising rates, probably, or if not, they have maybe one more. So what's to stop metals going higher? Well, I think they will go higher, but I'm not convinced this is the move yet. I'm not convinced we're going to avoid the trip towards the mid 1800s in gold first, because the positioning is still quite long in metals.
What's DSI saying about gold and silver?
I don't know. I haven't received it in ages. Blake, what's the DSI?
Yeah,
for gold?
Metals?
Yeah,
gold and silver.
Let me find that for you. Give me 1 second. Sorry, you caught me off guard here.
Okay.
Yeah.
Well, when you get to it.
So
yeah, here it is. So gold is at 45, silver is at 27.
Oh, really?
So
okay.
It's not like there's no enthusiasm. Okay, so I mean, there's no enthusiasm.
I was looking the other day at the what was it? The IG client positioning, which is public, right? They have it on the site. And out of all the instruments, the main instruments they have, the one that's the most long is silver. And, in something like 80% of clients are long. So, maybe sentiment isn't showing that, but, retail positioning is probably long. Well, at least that's what they're telling us. So do we need a flush lower first? I still think it's 50-50. That's why I'm not saying, yeah, this is it, get in and close your eyes and it's going higher. I think it is going higher, but I think there's a big chance that we go through 1840, 1850 first in gold. And correspondingly, 22 in silver or something like that, 22.20, and then we bounce in a huge way. But
all in concert with the dollar weakening and taking out new lows. That's going to be the thing that surprises people, because we're assuming there's new lows after Friday. I have to say I don't know.
I don't know either. I think it's 50-50. I think for metals to really fly, the Dixie has to break below 100.80 to take out those lows from April, May, and February before. Yeah. I mean, it could happen before, but I think that's going to be the key. So I would urge, if people are not looking to get long or do whatever, I think we need to see this getting resolved first. We need to see gold either drop below 1935 or go above 1985, and that's going to give us, I think, direction.
So maybe it's more of a yields play, because than a currency play. So we'll see. Yeah. I mean, if we break out here, that makes the case, I think, a little more negative for gold.
Which is really perverse, isn't it? Inflation is sticky, or people are saying inflation is sticky, so yields are going to be higher, which means everything is more expensive, which means metals are going to be cheaper. I mean, you find the logic in that. There's absolutely no logic anyway. And I was looking at the silver chart from the last 2-3 years, and you look at all the inflation that we've had, which has been pretty substantial, and silver is unchanged. How does that add up with everything else? Anyway.
This goes back to 2020.
Yep.
So, here we are.
big sideways consolidation. It's if you scroll, even if you go zoom even more out, especially in gold, it's just a massive consolidation sideways. Yeah. Anyway, let's see.
And that's something we had a trend for a few months and nothing since.
And Charles says industrial use is down to offset inflation. Actually, it isn't. If you look at the stats, it's being used a lot more than it was 5 years ago. In all this EV and solar panels and all that, which is really growing fast in use. So
in regard to that, Stel, I saw a tweet that China is building this huge solar manufacturing complex.
Yeah.
And they're going to be, that was, related to silver usage.
Yeah. And testament to that is that before 2020, there was a surplus of silver, physical silver being mined and used. And the last 2 years, there's been a deficit, and this year's deficit is projected to be even higher. So I don't know how long this can hold.
And the warehouse stocks have been dwindling.
Yep. Anyway, we can talk about metals for ages, but for now, I'm holding my horses. I don't think we've broken one way or the other. So I'm not doing anything more than I already have.
Okay, I'll talk to you next week. Anyway, good morning, K-Man. How are you, brother?
Good morning, Dale. I admire your dedication to the cause.
Yeah, we work on national holidays. Anyway, what are you thinking here this week? And do you, with the U.S. market, banks being closed, markets being closed, this looks like late European trading that we're getting here. Do you trust it on a day like this, or?
Oh, it's more like a bit of a sideways action, right? But we just have to note that two currencies are still very much under the cush, and that is the yen and Chinese yuan. And the one is thanks to the Bank of Japan leaving the green light, giving us still the green light to sell yen, or at least not to buy it, and to tell us that it's expensive to be long yen for a longer time. And then on the other side, the Chinese yuan, where likely next night for you, tomorrow morning for us, they will cut some rates again. And that's the two outstanding. For the rest, the dollar is on the defensive, pretty much, I'd say. Although some currencies are showing signs. The Aussie dollar, as you said, for instance, around that 61.8, and then that level on the Kiwi just above 62.30 has found reasonable sellers as well. So maybe the dollar is not completely dead,
Okay. Well, what do you think of China? Gates was there last week.
And Blinken was there and this morning, and he finally met with Xi, and they had their I'd say what we could have expected, saying that they are still cooperating and whatever, but nothing's been really said. Over the weekend, some Chinese officials he was talking to were clearly telling them to stay away from Taiwan. That is a core of the core Chinese matter. But on the other hand, we also have Vice President Li is in Germany and France today, tomorrow, I think. And we may have a couple of headlines there, because as we know, Macron and some of the other Europeans have said that they cannot decouple. They can de-risk from China, but they cannot decouple from China. So we have to
that's what I've been reading, and that's why. And I think both China and the U.S. are realizing that. And who needs to stay together more? Do you think it's China?
They all have to.
Yeah,
they all have to.
So they could stay together while they're. Yeah, go ahead.
China needs the money, and the rest need still. Even if you decouple a bit or
their stuff.
They need manufacture. They need their big manufacturing. So I think they still need each other.
Okay.
But it doesn't take back from the fact that in the meantime, just because of adding to the geopolitical scene, you add a PBOC that is injecting liquidity and lowering interest rates, where the rest are status quo at best at higher levels. That probably should still keep the Chinese yuan a bit on the defensive. Yeah.
Yeah.
And AstraZeneca also said that they want to sell out their operations in China. So that's another little thing that adds to pressure, I reckon.
Okay. So, I mean, if we're not going to new highs.
No, new highs is perhaps a bit far.
How about something like this back to 705, like a corrective pattern?
You know
like
what?
A, B, C, huh?
Yeah, that hold just above 710 was already well, significant. It's a percent away now, or less than a percent away still. But there's a bit of a level there around just above 710. But yeah, I mean, basically, if you look at the whole setup, it was all about, are we going back above 7 and hold or not? And we did, and we are well above. So I think if you look at the medium to long term, that's going to be your magic level again.
Okay. So in the S&Ps this week, the level to watch is, I didn't mean to do that. Anyway, the level to watch is the 4340 level, the throwover. So that's it. That's the level to watch. What do you think, Blake? I mean, we did get up to a Gartley pattern that you showed 2 weeks ago. I think it was around 44 and a half. You getting a signal up there?
Well, you didn't watch the week ahead video, Dale. Jeez.
See, my own questions bust me.
I got you. You know, when you pull up these charts and you ask me these questions, I know exactly that you didn't. But you know, here's the thing. And good morning, Dale. Good to see you. And thank you for being here. I know, by the way, I know you have Luke Groman on here today, and that's going to be an awesome interview. I'm super excited whenever you interview him. It's great. He's wonderful to listen to. And he's so knowledgeable. But okay, so you know, we really narrowed down the S&P here. We hit the 161% extension of, you know, this was the previous 2023 high at the very beginning of the year to the lows of this year. We actually hit that level as we were expecting. Now that would be the Gartley reversal point, you know, but the markets can overshoot. And I have a channel resistance coming in right around 4,500. So I think anywhere between 4,400 and 4,500, we're going to find resistance. And maybe Friday was it. Maybe, you know, maybe that high on Friday was the top. It's hard to say. I think these are the case I made on the week ahead video. I think that the risk reward does not favor the bulls. And as I explained on the video as well, you know, we're seeing a sharp bear market rally, and it looks like it might be complete. So, you know, I don't know, Dale. I'm looking for a bit of a reversal up here in risk. I don't know how it's going to translate to FX. I think the dollar is probably going to catch a little bit of a bid, which would make sense because if you look at the dollar index, I think we're forming some sort of triangle pattern. I drew this out and then I had to redraw it, you know, as we were talking on the video, but I think it's going to be consolidating. Now it's a bearish consolidation. Still looks like it could break down, but you know, I think we might be consolidating here near term. So
what based on DSI, Blake, is the market pretty still bulled up in euro and cable?
Yeah, I mean, that's not where the DSI is so extreme. The DSI is very extreme in not only the S&P,
VIX,
but also the NASDAQ. And then also in
90s,
the Nikkei, the yen, and the VIX. So, yeah, so you can see the Nikkei here, you know, has divergent relative strength, and you know, it's parabolic. It's parabolic, right? Right, exactly. Then you have the NASDAQ, very similar, and then you have the yen, which here I'll just put on the 6J. This is one of the charts that I brought up on the week ahead video because we had this, you know, equal leg A, B, C, D move. We're at the 618 retracement. If the dollar yen can get up towards 142, I'd say 142.50, which seems pretty logical or seems very likely that we could. That would take us back down to the 618. And, if we continue to be supported here, we have a lot of extremes in the yen that might actually, see a little profit taking if equities turn and the yen and the Nikkei turns a little bit too. And the Nikkei's got a lot of downside before we find support. I mean, which is so funny because if you think about it, and I'll pull up where I just had the Nikkei. It was Father's Day.
The one that's highlighted.
Am I on? I'm sitting here looking around because I just clicked. Thank you. I hope everybody had a great Father's Day, by the way, for those of you that were celebrating. I had my best round of golf I've had in about 20 years yesterday. So
you were like 50 over par?
That's exactly right. I shot 110. So but look at that. If we had a pullback from current levels, we could have a 7-8% correction and still just come back and hit the breakout point.
Yeah, good point.
I mean, that's right. I mean, and that for me, when you have a bullish breakout or a new bull market, which I think you got the Nikkei that's clearly doing it, especially with all the massive amounts of money that's being put into Japan, not only from what's his name? I can't think of
Buffett.
I'm sorry,
Warren Buffett.
Yeah, Buffett and company. Thank you very much. Why can't we see a little bit of a pullback, a retest, and that can really solidify the bullish breakout in the months ahead. So I think it's totally logical, and you can see the relative strength is kind of divergent. And so anyway, that's kind of my just overall view of the markets. I think that we have a nice area where
shot of risk off, maybe I mean a 10%, like you were just saying, Nikkei could fall 7%. A 10% correction in the S&Ps would not damage the bull case.
A 5% correction takes us back to 4,200, to the breakout point. The massive breakout point. I mean, and let's just say the channel, which is totally logical. I mean, you just connect the lows and then just connect that line right off the highs. There's your channel.
It's parallel.
Yeah, I mean, to reach the lower end of this channel, and it's summer, it's profit taking season. I mean, that's a 7% correction. Why not? I mean, normal. It'd be normal. But I do think that this is the one last point I want to make, and then I'd love to hear like Ryan, Stelios came in your opinion too, Dale. Bear market rallies are very convincing. I've been through, since the 90s, been through a few bear markets, and when you get reversals, they are convincing, and that doesn't necessarily, especially bear market rallies. So I'm not convinced that the world is okay and that we are recession free. I think we had 13 years of unparalleled liquidity thrown at the markets, and we're unwinding that massive monetary policy, like I said, more than a decade of extremely low rates. And now the market's going to, it's got to chew on that for a while. I think it's a multi-year process. It's not a we're finished, let's move along. But anyway, that's my opinion here. I still think that the markets are going to roll over here over the next couple of weeks. What are your thoughts, Dale?
This is where you try it. You never know if it's the top or a top until, you could look back in the rearview mirror a few months down the line. But I think it's an area to attempt it. Someone's saying the end of the quarter, it could stretch. But I wouldn't be buying the S&P up here.
No, I mean, risk reward doesn't favor that, right?
Yeah, and it did confirm, or close to confirm up there, But you know what has me bearish is if you look at the banking index. I'm still of the belief that the banking crisis isn't over, and that there's the regionals will make another new low, and I don't think the market will like that.
What's the banking index again?
Well,
KRE.
No, that's
the
regional. Seasonal one. I mean,
the big
regional
guys.
XLF. I say seasonal. I said seasonal. Oh my God, it's Monday morning.
XLF.
Holiday. What's the banking index?
XLF.
XLF. Thank you very much.
And these are the big guys. It looks almost exactly the same, except the magnitude of the drop in KRE was bigger. But is that a bullish formation there?
No, I mean,
and look, yeah, while the market's blowing off and making new highs, and KRE measures back to the COVID low. I was looking at it; they could take it down to 28. The COVID low was there. Yeah, there you go.
Yeah, I mean, I'm not convinced. Stelios, what do you think?
I think this is a bear market rally. That's I agree with that 100%, because if you think about it, all the rate hikes that we've had, the tightening hasn't really translated into equities at all, which is amazing. So, but the problem is, how do you time this? Because we've said for weeks now that it doesn't make sense to be long. Being short equities is fundamentally the right thing to do, because we are overvalued in quite a few metrics, and also if you think about the tightening, etc. But I've been saying for days and weeks, I wouldn't go against this because there's no technical evidence. So how do you do this? You have to see technical evidence that this is actually a turn.
I have one for you. That throw over that it took place in the S&P, it's a wedge it broke out of, and then it pulled back and almost exactly tagged it. Blake has it as a flat line. I have an ascending line that did the throw over. But it's at 43.50. So back under that low, I have it back inside. Yeah, that pullback was right to my line. So
you got something like this.
There you go.
Yeah.
So back under that formation, the throw over, be a failed breakout to me.
That's a start. Yes, I agree.
Yeah, and that's the point that Stelios is trying to make, Dale. I think it's a start. You got to look for the technical signs that a top is near. I mean, we can say, oh well. I mean, look, we've been targeting these levels. I mean, we had bull flag patterns. We had the 161% extension. We knew we were going to get up here, or at least really confident we were going to get up here. Now that we're here, what do you do with it, right? And what I think what you're trying to say, Stelios, which I 100% agree. You don't stand in front of it right now. You start looking for reasons that, like, hey, we are forming a top, because once a top's formed, there's going to be plenty of downside. Right. I mean, if it takes us, let's just say, I don't know, 100 S&P points to identify that a top's been in, there's probably, at least 200-300 points in downside. Right.
Yep.
Yeah. Okay. Well, Ryan, what do you think?
I think you're all talking gibberish.
Yeah, I know.
I'll tell you why. And this is all about, different views. Can you put it on a weekly chart for me?
Yep.
Oh, well, it's a bit messy there, but
here, let me do it this way. There you go. Here's
there you go. Yeah. So zoom it, come right out a bit so you can get 2010 in. Right. Can you tell me where your bull market rally is now? And that's not just a pullback.
Oh yeah, I mean it's a left to right, bull market. But again, let's talk monetary policy and tell me that wasn't a factor, and removing it is not going to be a factor.
No, I'm not saying that at all. But you look at the overall trend, and that dip that we got off the highs couldn't even get to the 38.2 fib of the big move from 2010. That's it. It couldn't even pull back properly. Yeah, take it from there to the highs.
That means that means there's still a chance that we get to the 38% chance to percent retracement.
There may be, but if you look at it, we had that big move off the highs, okay, on that chart, it looks like a pullback, and now we've spent weeks grinding higher. To me, that looks more than a bull market rally. It looks more like a getting back on the trend. But your key markers are those 2 high points you got there. If we hold there, then I think you've got something bigger building, and then maybe you're going to get that 38.2 fib at least. But it's going to need to hold around that 46 or even that 48 highs. If it doesn't, you can have one hell of a massive double top up there.
All right. Well, thank you, Ryan, for your input. And I didn't want to leave out K-Man because I know he's here. K-Man, you have any thoughts on like the overall markets and monetary policy and where we're at and where you think we might be in the next week or two?
In the next week or two? No, I mean, well, if you look at monetary policy, you have to look at it longer. But in the next week or two, I think there may be just a continuation or perhaps a little more sideways of stuff going on. And we take not necessarily the dollar as an example, but we are perhaps going to continue to trade a few crosses as well. Well, let's not forget that we have Bank of England this week, and then Norges Bank and stuff, and Ryan's favorite, Central Bank of Turkey. So yeah, I think there's going to be quite a few things perhaps moving on the crosses. Globally, as I've been saying before, USDCAD still, although we are at lofty levels in quite a few yen pairs, USDCAD leaves the door open to more carry trading, or at least telling us that it's too early to be long yen, because that hurts unless you're right straight away. So yeah, to me, it's still just a quite continuation. I don't know about the euro, really. I don't know. It could like the market, the way it trades this market, it's probably going to see 110 or above 110 likely. But then is it going to break the 111? I'm not sure. I'm really not sure. Data will have to tell us, and that's really about it. And about equity markets, I think we're going to stabilize a little bit. And there is something interesting that I read for those who traded on a more shorter term, is that the week after a very bullish quadruple witching week, and with the VIX lower, the week after usually it corrects a little bit. So I just wanted to throw that in here, that if it comes off from those highs that we see last week, don't be surprised. So that's the only thing. But I still think this is looking relatively bullish, those stock markets all in all, because as we've been saying, with yields not coming off, they can continue to. There's money still flowing in there, and that I think is still a result of. Or resultant of the 2020 massive liquidity injections, which are not completely out of there.
Well, you know who's going to be a great person to answer these questions, Dale, is we have Mr. Luke Groman here. So I'm thankful that he's here on this holiday, and I'm going to pass. I want to first of all say thank you, team, for being here today. I know, like I said, it's a newer U.S. holiday, and for those of you that are listening in, really appreciate you. And Dale, thank you for hosting us as always. And I hope you all stick around for Luke. He's probably one of the best macro guys around. So Dale, take it away.
All right. Well, Blake, I hope you can see the forest from the trees. If you can't, we have Luke with us. Luke, great to have you back and be able to catch up with you. A lot of things have happened since you and I last talked. What's top of mind for you?
I think top of mind for me is just there's a lot of conflicting signals right now, right? So you've got, weakness in some macro indicators that have been, from a fundamental standpoint, that have been very good leading indicators throughout my career. So you talk about cardboard box volumes are collapsing against tough comps, RV sales collapsing against tough comps, heavy duty truck net orders have been down for the last 6 to 8 months. The flip side of it is you've also got some fundamental things in the macro side that are looking really positive. So the factory U.S. manufacturing construction spending is absolutely exploding higher at an unprecedented rate. I mean, it has gone from like a rate where it's run 80 billion a year, give or take, over the last 20 years. It's exploded to a $190 billion rate annually. Wow. And some of that is tied to what the government has been doing in terms of incenting reshoring and the inflation reduction. So on the fundamental side, you have these two things pushing against each other. And then where I spend a lot of time as well is on the fiscal side for the U.S. And you have here too sort of conflicting forces pushing against each other. So you've got U.S. tax receipts falling at the fastest rate in. I mean, really, your tax receipts are on a trailing 3-month basis, year over year. You're in a bad recession already. They're down 25%. But here too, it's off very unprecedented highs, but they're down significantly. Flip side is you've got U.S. outlays exploding already, which is, again, also what you usually see in a recession. And some of it is because of, not some of it, it is significantly due to some pretty unique historical factors. Number one, the increase in interest rates, the fastest pace in 40 years. And number two, that's hurting receipts. It's increasing outlays. And number two, the demographics are what they are, and the entitlement bill is picking up secularly, and that's driving that up. And so it's this really weird time, because when you think about it and take a step back, if the U.S. increases interest expense $600 billion year on year, fundamentally, there's no difference between that and a $600 billion stimmy payment that we were doing 2 years ago. The only difference is A, who it goes to, and B, the marginal propensity to consume of who it goes to, right? So you give $600 billion to everybody in their bank account, we saw what happens. Yeah. You give $600 billion to the wealthier
corporations.
Class. But it ends up in the economy at any rate. And so you're in this weird time, and I guess I would overlay that as well. You're now seeing U.S. shale production start to peak and roll over. And that has been a disinflationary force that has given the Fed space. Basically, shale's starting to look like a collateral casualty of Fed rate hikes and U.S. SPR releases for going after Russia, which is what I thought would happen all along, but it's starting to happen. So you've got this sort of really weird mix as we start to get to the middle of this year, where you could see energy inflation pick back up. You've got deficit stimulus pushing up on inflation. You've got fundamental demand down in some areas pretty badly, up in other areas. And so it's just this really weird, for me, a really weird period of time to have a whole lot of conviction one way or another. It's like a big decision points coming.
Yeah. How about with, and something you didn't mention, and even pros aren't talking about it anymore. Don't you think we still have an ongoing banking crisis here in the U.S.?
Oh, yeah. Oh, absolutely. And
won't that overshadow all the numbers that we just talked about for the last 10 minutes? Something that it's bigger. It's a much bigger issue than, which part of the economy is doing better now. Don't you think?
I think that's exactly right. And thank you for highlighting that, because I should have brought that up as another factor that is a negative, where I think we are right now in the burn off of, I think there was a whole lot of people looking at that March, April, May, myself included, talking about it. I think positioning got very negative around it. I think we're seeing a reversal of that. Some of that is tied to the AI excitement, et cetera, whatever, Fed pause or transitory pause, whatever this is. But absolutely, this banking strains crisis. Number one, it was a fiscal crisis. This is still fundamentally, Fed encouraged the banks to buy all these treasuries and then raise the rates on them. They're upside down, and that hasn't changed. And these deficits are getting worse. And so you're getting this period of time, I wrote about this a few weeks ago, of you get into the back half of this year, you're going to have the Fed doing QT. The banks aren't buying treasuries in all likelihood anymore because they're still upside down. They're looking for help.
They're still going to the facility.
They're still there. Facilities
they're still, we need it. Bring it. Bring it.
Yep. So, and then you still have commercial real estate, which is, people have stopped talking about it, but there's a whole lot of refinancings that are going to need to come in commercial real estate. They're going to need to come venture capital. I hear credible rumblings. There's a lot of stuff that's upside down there that's going to need to come to market. So you're going to have this, I called it a capital crunch coming in the next 3 to 6 months, where the U.S. government's got to raise a bunch of money.
Yeah.
CRE needs to raise a bunch of money. Venture capital needs to raise a bunch of money. And in theory, that should be really good for the dollar and maybe gold and not a whole lot else. It starts to take us back to that sort of 2022 regime from kind of March of 22 to September of 22. Powell is maybe trying to foam the runway by pausing here for a moment. And I think that's probably a valid interpretation of what he just did. But the bottom line is there's not enough global balance sheet without the Fed. The Fed's going to have to come back, I think, or else, yes, you can burn down the RRP and that gives you some room. But at the end of the day, even with the RRP, there's not enough global balance sheet. The Fed's going to have to probably be cutting or growing its balance sheet again to prevent that from being risk negative. I think it's a very valid point, Dale.
Okay, so it being, maybe they're late to the party like usual, and they see the whites of the eyes like some type of risk event. Yellen used more banking consolidation. To me, that's code word for failures. So
I think that's probably right. Yeah.
Do you think that they may take draconian steps and limit withdrawals to see that as a solution?
I think that would be right before yield curve control in terms of how they don't want to do that. So yield curve control is the Hotel California for the Fed, right? Where they're never going to buy the bond market when that happens. And I think it's a when, not an if. So they don't want to do that. That'll be the last thing to do. I think the second last thing they would do would be these deposit controls or something like that, because that is simply, the US dollar is the global reserve currency, and rule number one of global reserve currency, as it's been structured since 1971, is no capital controls. So you start putting capital control, that's a dollar that has major implications.
That's giving a win to the BRICS. That may be the whole reason then that they don't do that.
I think, I don't think they do that for that reason, because really the dollar typically is per view of Treasury. And so that would be a Treasury decision. And I just don't think they'll do that.
Okay. What do you think Bill Gates was doing in China? Didn't he give you his itinerary?
Yeah. Who knows?
Why does Xi want to meet with Gates? I mean, he saw Xi. It's strange, isn't it?
It's very strange. Now, I will say, I'm out of my depth a little bit here. This is not.
But you were talking about that. It won't serve the U.S. to decouple. I think there were some comments out of Europe today echoing what you were saying, that nations can't afford to decouple from China.
No, they absolutely can't.
And I think China can't afford it either, can they?
No, what you're talking about, if you get a hard decoupling, however that happens, hard decoupling economically, some sort of hot war, you're going to get basically a soft version of instant global hyperinflation everywhere. It'll be, I think the right way to think about it is the post-World War I analog, right? Where you're going to have China, who's got a whole bunch of factories and no place to sell the stuff. And so they're going to have to create some sort of domestic, wooden nickel program, domestic stimulus, right, to basically create consumers overnight to buy their own production. So they're going to have deflation in China, and then in areas that are short energy or short other goods, the U.S. really is running this gigantic current account deficit, right? So we're $1 trillion trade deficit that is going to be short goods. So you're going to be short $1 trillion of goods. That is a way to think about it, minimum, assuming there's no sort of, goods go into goods.
We're short a lot of oil right now too, aren't we, Lou?
We'd be short. We'd probably be short oil, but then we'd be short buyers of treasuries. So you're going to be, you're going to have no place for your treasuries, and you're going to need a lot of stuff. And that's a really toxic combination where rates go up and inflation goes up, and the bond market crashes globally overnight in a hard decoupling. So I see these people talking about it, and I don't know whether they're simply jawboning or trying to establish a position, or whether they're not thinking of the second derivative, which unfortunately this administration, the administration before, last several administrations in this country haven't done a lot of second and third derivative thinking. They just sort of act and then deal with the consequences. So maybe she's trying to talk to Gates as a business person with experience there to say, hey, what's really going on here? Who knows? But a hard decoupling would be very, very tumultuous for markets.
Okay. The overriding, so on the business plane, they could come to terms, but it sure seems like we're still poking the tiger in the eye with trade pacts with Taiwan that just passed. And it seems like we're playing like a, dual game. Let's do business, but, we're not going to let you take Taiwan, and we're going to supply them.
Yeah, and to me, it all ties. It's fascinating, right? My late father-in-law was a Teamster official for a long time, and I used to play golf with he and a couple of his buddies. That one of whom was an old Italian Cleveland guy. So the conversations were always really interesting. But this was call it 01, 02, 03, 04, 05, right when China goes into the WTO, and what the U.S. administration and some of its senior policymakers and think tanks are saying about China today are what these guys were saying about China 20 years ago. And like these guys collectively, the other three I played golf with every week, they collectively had 0 days of college amongst them. But they were very street smart. They understood business. And they were asking, like, okay, like, I get it. You're going to lower labor. You're going to lower labor costs. You're going to take away the power from unions. But then what?
Yeah.
Then you're going to be
hollowed out.
Yeah, exactly. And that's exactly what's happened. So to me, a lot of this rhetoric, I think, is on some level lashing out because the U.S. realized they've made a mistake. They've been had. They were outplayed. Based on someone willing to look a bit longer. And now, you look, Taiwan makes 90% of the world's semiconductors? Like we're not, what are we, the US has to make a choice. We want to bring semiconductors back. Terrific. Let's do a $5 trillion stimulus, $5 trillion printed out of thin air, monetized by the Fed, trillion a year invested for the next 5 years. And that's assuming we could find the labor and this and that and the other. But then the bond market gets killed on a real basis. The Fed has to come in and monetize the bond market. And that's when you do a lot of dumb things for 20 years straight on borrowed money, you find yourself in a position where there's not a lot of good choices anymore. There's just varying degrees of bad choices. And I think some of this poking the, and seemingly incongruous actions from the US, I think, are on some level a reflection of the reality that they've cornered themselves, that there's no good actions. And it's not like China has issues of their own, but strictly from our perspective, the poor chronic short-term decisions we've made for the last 20 years are coming home to roost.
Well, I read your stuff, and you say we're getting closer and closer to an end game. I'd like to know when you think that might be. Could it be next year? I know Gann has 24 as a bad year. I mean, we're going to have all kinds of stuff happening politically, and we're going to see what the Fed is going to do. And I'm wondering if your end game ends up being that something we didn't employ, but you felt we had room to a few years ago, were to go to negative rates. And that you said, even when we were near zero, that they still could fall a lot further. There was historical precedent for them to fall further. Is that on a real basis? Is that part? So maybe we're peaking in yields here, and that's going to be part of the end game?
On a real basis, yeah, absolutely. I think we probably are peaking in real yields right here. And I think, yeah, when you talk about 24 being a bad year, I would say, when's the window for that sort of end game of the of real rates heading back to significantly negative rates. I would say the window's open now. And the reason I say the window's open now is of that couple parts of that toxic combination that we talked about at the start, which is number one, you've got this potential credit crunch coming up, right? Where you've got the US government's going to have to borrow a lot, CRE, VC, all of that's going to start playing out in the back half of this year and into first half of next year. That's number one. So those guys need lower rates. Number two, you've got the US fiscal situation leading to it's untenable, and it's leading to higher levels of inflation, right? Where the US government's, they're 25% of GDP, deficits at 8% of GDP. You have a recession. Last three recessions, we've seen deficits go up 6, 8, and 10% of GDP, and we're already at 8. So in a recession, we'd be looking at 6 plus 8, 8 plus 8, 10 plus 8. We'd be looking at 14 to 18% of GDP deficits, nearly World War II level deficits, and foreigners aren't buying enough of them. And in fact, in a recession, the dollar's rising, the foreigners are going to be selling treasuries like they were last year. So you're going to look at net effective supplies of treasuries, probably near 20% of US GDP, $5 trillion a year. There's nobody with that balance sheet. So you're going to have
that's crowded out. That's crowding out all the other borrowing that has corporate, municipalities, everybody.
All of it. And the third thing I would say that, so that's, you layer that on, and that's why I say the window's open. And then the third thing is peak cheap energy, where the US made a bet effectively when they ran down the SPR at the fastest pace in 40 years, that basically Russia would break before US shale would break. Russian oil production or the Russian political situation would break before US shale. And the bottom line is, yes, oil's down. Yes, Russia's deficits, our fiscal position is straining more than it was a year ago. But Russia's oil production is still up. They are okay. And shale is rolling over. And shale is a very unique geological animal in terms of once it rolls hard. It has a very high natural decline rate. And so the point here is you're going to be looking at this deflationary impulse of a credit crunch, the inflationary impulse of the fiscal crisis, and then oil actually starting to rise again underneath them. That is the absolute toxic, it just absolutely, cocktail.
We'll all be drinking that cocktail.
Yeah, that's exactly it. And I think volatility will rise meaningfully. I think there will be times when it's really good for the dollar, really bad for the dollar. You're going to see, I think we've already started to see the volatility in things that most of us have never seen in our careers, right? When we go back to March and the 2-year treasury yield trades like Dogecoin, I think that's going to become much more normal. I think gold going up 50 and 80 points, in a 100 points in a week, that's going to be normal. I see Ronit saying, Dixie up 10% today. Exactly. That type of stuff, I think, is going to become more normal as, like I said, this window opens with these three big factors that are very historically.
No one's worried. My proof is VIX 14.
Oh, right
There's
now it's really
complacency like I've never seen.
Yeah, that's like AI is going to fix everything, and positioning in AI. Everybody knows about the credit crunch, and it reminds me a little bit of if you remember, like the April, May, June of 2008 timeframe, where, or even maybe even 07 is probably the better analog, but either one of them, right? There was like this period of time where Bear Stearns blew up. And then George Bush came in with a stimulus, and everyone was like, oh, well, stimulus is going to make it just fine. And I remember talking to clients like, are you kidding me? There's all this other stuff yet on the come. And
it took a year. Well, I think it was Washington Washington, whatever, that bank.
Yeah, Washington Mutual.
Mutual, right. And then it was Bear Stearns. And Lehman didn't happen until a year after Washington Mutual.
Yeah, exactly. And it was, so there's like this complacency of like, okay, well, remember, I think it was May of 07 when Bernanke's like, subprime, yes, there's a problem in subprime, and subprime is contained. Like the stock market didn't even peak until October. So you had another 5 months of gains in the S&P. And then there was just catalyst. And I think the catalysts start to come fast and furious in the next, 3 to 6 months. but there's like this optimism. Hey, the Fed stopped AI, productivity. And then I think we're going to have that with punches in the face of reality. Like, oh God, oil's back at 80. Oh God, oil's back at 90. And oh God, the fiscal deficit is, oh gosh, the big commercial real estate,
you never know. It's like one last snowflake causes the avalanche.
That's exactly it.
Point. You never know.
The 10 years at 4.5, or it went back to 4. Now it's at 4.5. And and that'll be enough to sort of go, oh, wait a second. Like, why do I own tech with the 10-year at 4 on its way to 4.5 in a hurry? And the answer is you probably don't.
I'll tell you what, people, if you want to learn a lot, this is where you go. Go right here to Luke's website here, FFTTLLC.com. And you can, check him out, get, some of his stuff that you're prepared for these times. And this is historic and maybe the biggest, change in our lifetime. Last thing, Luke, do you think that the Fed, since you said they knew the banks loaded up on their paper, per direction of the Fed, help us out, buy this stuff, and then they go up to 5%. They knew they were going to take down banks by doing this. They knew it, don't you think?
I think
intentional.
I don't think it was intentional. I think the Fed, the big bet underlying it all was inflation would never come back. Like, I think that was the thing that surprised them all. I think they really thought was that inflation was never going to come back. And then also, when you go back to August 2019, Stan Fischer, who was the former vice chair of the Fed, wrote that paper with the head of the Swiss National Bank and the former governor of the Bank of Canada. And they said, in the next crisis, we're going to go direct. We are going to have the fiscal side print a bunch of money and spend it into the economy, and the central banks are going to cap yields, and real rates are going to go very negative, and inflation will be very tricky. Once you let it out of the bag, it's very tricky, but this is what we're going to do. And it's interesting. So Fisher was Bernanke's teacher. He was Draghi's teacher. He's the godfather of central banking. So I think they on some level, so I would restate a little bit what I just said before about this inflation suppressing it. I think they did exactly what Stan Fisher and others said they were going to do in the next crisis. COVID, they spent a bunch of money. The Fed capped yields. They had the banking system help them. I think what changed was the political situation in Washington, because it looked like they were running that playbook. And then all of a sudden, February, March of last year, the Fed gets panicked about inflation. And I think the Russian invasion changed things as well. I still think there's an element of what the Fed has done was a weaponization of the dollar to try to punish Russia. And I think those two factors combined basically changed the rules in the middle of the game for these banks. And you kind of go, well, what the hell? Like, you got me to buy this stuff, and now I'm upside down to the tune of hundreds of billions of dollars, collectively as an industry. So I don't think they did it on purpose. I think they were surprised by the pace of inflation, or panicked maybe, but panicked because of the political situation.
Well, they could have told people to do something about duration. They knew they were going to take rates up dramatically.
Yeah,
and you would think nothing.
They did nothing. And my understanding, and I don't know if this is the case, but there's people I respect that have pointed this out to me, that the accounting treatment for banks is such that they have to move it, I think, out of held to maturity to available for sale if they apply hedges to it, which means they have to take the marks on a daily basis. So there was actually apparently a strong disincentive to do that, right? Because basically, if you're a bank manager, and again, I've heard this, I've not done this myself, but some people I respect have pointed it out to me. But if that's the case, if you're a bank manager, you're stuck, right? You're like, do I hedge and come out to Wall Street and take down my earnings 20%? Or do I just bet that the Fed's going to stop and reverse and just leave it in held to maturity? And for 25 years, the right bet has been wait, held to maturity, put it in held to maturity. The Fed's got your back. And so it was a rule change mid-game, I think, that surprised a lot of these guys.
Yeah, hope. Hope is the oxygen in our lives and the carbon monoxide in our investing.
Yeah.
What do you think, huh?
I like that one.
Well, Luke, great catching up with you, and really appreciate it. One more question. We're going to have digital currency here in the U.S.
I don't think it will be widespread. I think it will be to, if you look at the unemployed workforce, the part not counted in the labor force group, I think, that will be, digital. I think welfare benefits and certain healthcare and entitlement benefits will be paid that way. I don't think you'll see it broadly, but I could be totally wrong on that.
Okay. I hope you're right. And appreciate you being here, buddy.
Yeah, absolutely. Thanks for having me on.
Yeah, great time. And congratulations on being on CNN.
Oh, I appreciate it.
It's great that you're getting your message out, because I consider you a watchman for all of us.
Thank you. I appreciate that.
Luke Roman, everyone, follow him on Twitter at Luke Roman and get his stuff. You're going to need to know what he's thinking during these times. Thank you, buddy.
All right. Thanks for having me on, buddy. We'll have a great day.
All right.
Bye-bye.
Luke Roman, everyone, and you could join the team in 14 minutes on the Morning Edge. Adios. Hope you enjoyed Luke. Okay. So he sees it getting closer. We can't go on forever juggling 100 balls in the air without dropping a few. That's my view. And don't forget to not just count your pips, count your blessings. We'll see everyone tomorrow with the markets cooking. Bye-bye.